If you've been trading Forex and you keep losing trades, there's a high chance you are missing one of the most important concepts in the market, which is demand and supply. Most beginners focus on indicators, signals, or random entries, but the truth is, the market moves because of one simple reason, which is imbalance between buyers and sellers. In this video, I am going to break down demand and supply in the simplest way possible so you can understand how price really moves and how to find high probability trade setups. Before we get into this, if you want to learn how to trade the market the right way using demand and supply, make sure you hit the subscribe button. First, let's understand what demand and supply zones are. A demand zone is an area where buyers are strong, meaning price is likely to move up from that level. A supply zone, on the other hand, is an area where sellers are strong, meaning price is likely to move down from that level. The simple logic is that when there are more buyers than sellers, price goes up, and when there are more sellers than buyers, price goes down. It is that simple. But here is where most traders get it wrong. They don't know how to identify these zones properly. Let's look at the chart for a proper explanation. On the chart, what you want to look for is a strong move in the market. You are not looking for a slow movement or chubby price. You are looking for a sharp move, something aggressive. Now, before that strong move happens, you often see a small area where price pauses or consolidates. That small area is what we call the base. So you have three parts: the move, the base, and the explosive move. For a demand zone, price will drop, create a base, and then rally strongly. For a supply zone, price will rise, create a base, and then drop aggressively. Now here is the key: the stronger the move away from the zone, the stronger that zone is. For a demand zone, you mark from the lowest point of the base to the highest point of the base before the strong move up. When price returns to the zone in the future, there is a high chance it will react again. This is where you look for entries. And for the supply zone, you mark from the highest point of the base to the lowest point of the base before the strong move down. Keep your zones clean and simple. When price returns to the zone in the future, there is a high chance it will react again. This is where you look for entries. But don't just enter blindly. Wait for confirmations like a rejection candle or a break of structure. Another mistake beginners make is marking too many zones. Not every zone is valid. Focus only on the strongest zones, the ones with the explosive moves. Quality over quantity always. Always trade in the direction of the higher time frames. If it is bullish, focus on demand zone. If it is bearish, focus on supply zones. So to summarize, find the strong move, identify the base, mark your zones, and then wait for price to return. It is simple but very powerful. If you master this, your trading will completely change. If you find value in this video, make sure you subscribe, because in the next video, I will show you how to refine your entries and start taking high probability trades consistently.